Hello there. I trust you are doing great and that you are doing so well. If you are new here, I go by the name Boatin Samuel here, but you can call me BY Samuel, and I welcome you to the BY class. The class which seeks to simplify complex lessons and make it very easy to understand. So stay tuned because we have a lot in store for you. So to get on with today's lesson, we are tackling the topic the day books or the journals. The day books or the journals. And for our objectives for the day, we are expected to understand the meaning of day books, the sources of information for the day books, and also an additional information we'll be tackling the trade discounts and cash discounts. So stay tuned and don't miss out. But before that, I would like you to take a moment to like and then comment with any question when the lesson is going on and you have any question, just drop it in the comment section and also subscribe to the channel so that you don't miss an upload. Now to get on with what we have for the day, I would urge you to take your books and get your pens ready as we get started on rewriting the stars. So to begin with, we'll be looking at the meaning of day books. We'll be looking at the meaning of day books. And one may ask, what is a day book or what are day books? So the day books or journals are books where the first entry of business transactions are made. This one is very self-explanatory. This one I need not even explain further. This one is very simplified and easy to understand. The day books or journals are books where the first entry of business transactions are made. So every business transaction that happened in the organization, the first place to record them is what we term as the day books. The first book to record the transactions inside are what we call the day books. I hope this is very clear. Now they are also called or referred to as books of original entry. Why are we giving them the name books of original entry? Books of original entry because they are the first place we record them. So if you want any transaction, if you want to know the true nature of a transaction, that is the very first place we can visit or we can go to get the original transaction because that's the first place they were recorded. So if that's the first place they were recorded, that means that is the original source we can sort or get our information from. So that is why we call them books of original entry. Another name can also be subsidiary books or the books of primary entry. And all these names, whether original entry, subsidiary books, primary books, or the day books, or even journals, they are all referring to one specific book, the book in which the first entry of business transactions are made in. I hope this is very clear. And with this, there are seven types of day books. There are seven types of day books. We won't be talking much about the seven types here, but we are just going to do the listing here. The next video would be tackling the seven types of day books. So stay tuned and then watch out for that one as well. So the first one we have is the sales journal or the sales day book. Then the second one we have is the purchases journal, which is also the purchases day book. So it's either a journal or a day book. The next one is the cash book. For this one, we do not call cash book journal. We just call it a cash book. That is the name, cash book. Then the fourth one we have is petty cash book. This is also the name, petty cash book. Petty cash book. The fifth one is returns invoice journal. Returns invoice journal. We will be looking much about it in the next video, so stay tuned. And then we have the returns outwards journal. The returns outwards journal. And then finally, which is the seventh one, we have the general journal. The general journal. Now, let's look at the sources of information for the 7 day books we mentioned earlier. The sources of information. What the sources of information refers to is the source documents used by the accountant as the basis for making the entries. So where the accountant gets the information from, before recording them into those 7 types of journals is what we call the source of information. The place where the accountant gets the information from or the entries from is what we term as the source of information for the day books. So the first one says sales invoice. Sales invoice. Now the sales invoice gives details of goods sold on credit, such as the price, quantity, trade discount, etc. So what this sales invoice gives us is the details of the goods we sell on credit. So I am a business and I've sold goods on credit to someone. In order for me not to forget the person I've sold the things to on credit, so that I can take back my money when the time is due, I give the person an invoice, and that invoice is called a sales invoice. And what this invoice, the information this invoice keeps, the information this particular invoice keeps is only sales that we make on credit. That is why we call it a sales invoice. It gives us information on sales on credit. So like the goods the person bought, the quantity the person bought, the price of the goods that the person bought. And if I gave the person a discount, it is also indicated. So whenever the time is due for me to take my money back from the debtor, I would visit this invoice and then I'll know the exact amount I'm supposed to what retrieve from the person. And this is a source of information for the first type of journal we mentioned, which is a sales journal. The sales invoice is a source of information for the sales journal. Now let's move on to the second type or the second source. This is the purchases invoice. So this one becomes the opposite of the sales invoice. Now, if the sales invoice is giving us details of goods sold on credit, the purchases invoice gives us details of goods bought on credit. So this time around, we are not selling, but we are rather going to what buy. So the things we bought on credit from our suppliers or our creditors, we can get the information from the purchases invoice. We can get the information of price, quantity, and then if they gave us a discount, we can get all there. So that when the time is due for us to go and pay our debt, we know the exact amount we are expected to pay. And this also becomes the source of information for the purchases journal or the purchases daybook. I hope this is very clear. Now the third one, debit note. The debit note is a document that shows the value of goods returned to suppliers or the amount overcharged by the supplier. So what this debit note states or gives them, it gives us the information when we go out to purchase an item from a supplier. And then when we brought the items, we realized that some of the items were damaged or some of the items were spoiled. We have to refund or we have to send back the items so that our monies will be refunded to us. So when we return the items, we give the supplier a debit note. And what this debit note is going to do is that he's going to refund, or the supplier is going to refund our monies back to us. Because in this case, the supplier is receiving the spoiled goods. And then the fundamental law of accounting says debit the receiver. So if the supplier is receiving the goods, then that means we are going to, that is the debit note. We are going to give the supplier a debit note because the supplier is receiving the spoiled goods. Now monies will be refunded to us. In another situation where the supplier has overcharged us, we purchase an item of 100 cedis, priced at 100 cedis, and then maybe the supplier gave us the amount the supplier asked us to pay was 120 cedis. So after going or leaving the place, we later found out the supplier has overcharged us. So when the supplier overcharged us, we have to go there and give the supplier a debit note for the supplier to what? Refund the 20 cedis increment to us. And that is what we term as the debit note. And the debit note is the source of information for the returns outwards journal. the source of information for the returns outward journal because we were returning the goods, the sports goods to the supplier. I hope this is very clear. Now we come to the credit note, the exact opposite of a debit note. So the credit note shows the value of goods returned by customers or the amount overcharged by the firm. So this time around, we've sold goods to someone or we've sold goods to our customers and they are returning the sports ones to us. So because they are returning the sports ones to us, we must credit their account. That means we must refund their monies back to them because in this case, we are receiving the item. So if we are receiving the item, we will debit ourselves and credit the customer's account with a refund. In a situation where we also overcharge the amount they are expected to pay to us, that one too, we have to refund their monies back to them. So this one becomes the source of information for the returns inwards journal. Inwards because they were returning to us. So returns inwards journal returning to us. I hope these four is very clear or are very clear. Let's move on or continue with receipt book. The receipt book. As we all are familiar with receipts, maybe you went to purchase an item, blah blah blah. Yeah, the receipts that you are given. So it is a document which contains information for cash and check received from customers. Cash and check received from customers. So when the business or the company receive cash from the customer or from any other person at all, or receives a check from any other person at all, it becomes an information which is recorded or it becomes a source of information for the cash book. It becomes a source of information for the cash book. These ones are receipts, the ones we receive from customers. So it becomes a source of information for the cash book. Now on the next one, which is check counterfoil, gives information of checks issued out. So this one too becomes the opposite of the receipts. So this time around, we are not receiving it from customers, but we are rather issuing it out to them. So we issue out a check to a customer or a supplier or whoever we are dealing with. That becomes a check counterfoil to the business because we are issuing it out to the customer or out to a second person or the other party. And this also becomes an information or a source of information for the cash book. Because the first one, which is the receipt book, was dealing with the ones the business was receiving. And then the second part is dealing with the ones we are giving out. And remember, the cash book records transactions of banks and cash transactions. So it doesn't matter. The very moment it's a bank and cash transaction, it is recorded in the cash book. I hope this is very clear. Then we have the pay-in slip. It keeps record of all deposits made by the current account holder. So every deposit, whether cash deposits, whatever thing it is, that is made by the current account holder, it is recorded within the pay slip. It is recorded within the pay slip. So that is where you get all informations regarding deposits in the bank. And then the last one we are talking about here is the petty cash voucher. The petty cash voucher. It records petty expenses like taxi fares, postages, cleaning, detergents, and all those things. So you see, when the institution or the organization is a very big organization, which deals with thousands of monies and thousands of CDs or thousands of dollars and blah 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 here and there. And then you are going to record a taxi fare of, let's say, 5 cedis amongst these transactions. You see, it will not make the entire thing sound reasonable or authentic. So because of that, as part of classification in accounting, it was decided that all major transactions are recorded separately in the cash book. All major transactions that has to do with cash and bank are recorded within the cash book. And all petty expenses, in other words, all small small expenses are recorded in the petty cash book. In other words, small cash book or little cash book. So the small cash book or petty cash book records smaller transactions or petty transactions or expenses. I hope this is very clear. So where we get the information for the petty cash book is what we call the petty cash voucher. The petty cash voucher. And then that is the source of information for the petty cash book. Now, as an additional information, we'll be looking at the types of discounts we have. The types of discounts, which is the trade discounts and then the cash discounts. So to begin with trade discounts, we say it refers to allowances or reductions given to buyers on the price list for bulk purchases. It refers to allowances. It refers to allowances given to buyers on the price list for bulk purchase. So what this type of discount is given to buyers in order to encourage them to buy plenty things. For instance, if you come to my shop and you tell me you want to buy a bag of rice and I say I'll sell it to you at 300 Ghana cedis, then I further explained again that if you want to buy 10 bags of rice, now that one for 300 Ghana cedis, I would have to reduce it because now you are buying more. So I can decide to sell it for you at 290 cedis for a bag because you are buying 10 bags. Or in other words, you say you buy 20 bags, then I would say, then that one too, I would have to do a reduction of it. I would have to give you a discount. So in that case, I'm going to reduce it to 280 cedis for you. That is what we call the trade discount. Because the more you are buying, the lesser you are paying for for a unit price. The more you are buying, the lesser you are paying. So all what a trade discount does is it encourages bulk purchase. It encourages the buyer to buy more because the more you buy, the lesser you are paying. Now let's take an example. Sam sold goods to Erica at a retail price of 100 cedis. And upon Sam thinking about what the quantity Erica is buying and all that, Sam decided to subject the transaction to a trade discount of 10%. So because Sam is giving Erica a 10% reduction in the price, which is the 100 cedis. Now let's look at the amount Erica will now be paying because of the trade discount given. Now we will first of all have to calculate the percentage Sam has given to Erica into cash. So in calculating for that, it is the percentage times the actual money Erica is expected to pay. So that will be 10 over 100 times 100, which will give us 10 Ghana cedis. So that means Sam is reducing the 100 Ghana cedis by 10 cedis. So in the real sense, now because of the discount given, Erica is going to pay 100 cedis minus the 10 cedis, in which will give us a 90 cedis. So instead of Erica paying 100 cedis cash, now Erica is no longer going to pay the 100 cedis, but rather paying what? 90 cedis because of the trade discount. She bought in bulk. I hope this is very clear. Now let's move on to the next type, which is the cash discount. Now the cash discount is an allowance given in order to encourage customers to pay their accounts promptly. So whilst trade discounts is encouraging people to buy more, the cash discount is encouraging the customer or the people to pay their accounts very fast or to pay their monies very fast. So an example is when you come to purchase the same bag of rice and I tell you, oh, because you are buying, let me say, a bag, or let me use another example for it to be very clear. I'm selling a land and then you come to ask me the amount or the price of the land, and I tell you it costs a 10,000 Ghana cedis. The land costs 10,000 Ghana cedis. Then you tell me you don't have the full 10,000 Ghana cedis. Then I decide to draw a plan for you. So because you don't have a full 10,000 Ghana cedis, I'll tell you If you are coming to pay the 10,000 Ghana cedis at the spot, then I would give it to you at, let me say, nine 99,000 Ghana cedis. 9,000 Ghana cedis, sorry. Because you are coming to pay at the spot, or let me, like 9,000 is going to be a little bit too huge. So because you are paying the full money at the spot, I would sell it to you at the 10,000 Ghana cedis. No reduction, no increment. But if you want to use 3 months to pay for the money, then I would have to add 3,000 Ghana cedis to it, making 13,000 Ghana cedis. If you want to use a half a year to pay, I would have to increase it again to 15,000 Ghana cedis. If you want to use a full year to pay, then you would have to buy it at 18 Ghana cedis. Now you see, the more you delay in payment, the more you are expected to pay. So with this one, to forfeit all those increments, then you have to pay the money right at the spot so that there will be no increment. You just pay your 10,000 Ghana cedis, then you take your land. I hope this is very clear. So the cash discount is a discount that is given to encourage what? Prompt payment, fast payment. While trade discount is given to encourage bulk purchase for you to buy more. Now in details, the cash discount. Now let's look at the next. The cash discount has been further classified into two types. We have the discount allowed and then the discount received. Now let's tackle discount allowed first. Discount allowed is given to the customers. Discount allowed is given to the customers. So I am a firm, you come to purchase from me, and then I give you a discount. The discount I'm giving you is called a discount allowed. And for that matter, it becomes an expense to me. It becomes an expense to me. So when you come to purchase the item, and then I decide the item costs, let's say, 50 cedis, and I decide to give you a reduction of 5 cedis so that you come and pay me 45 cedis. You will see that in the end, I'll be losing the 5 cedis discount I gave you. And that 5 cedis that I'm losing is what we term as the discount allowed. I have given you that reduction. So it becomes an expense to me. Instead of me getting 50 cedis, I'm getting 45 cedis. So I've lost 5 cedis and that becomes an expense. And so discount allowed is always treated as an expense. Discount allowed is always treated as an expense and it is given to the customer. Now discount received. Discount received is obtained from suppliers. Discount received is obtained from suppliers or customers. So in this time around, I go and purchase an item from a supplier or a creditor, and then the person decides to reduce the money I'm supposed to pay. It becomes a revenue or a profit to me. In a situation where I go to the supplier or the creditor to purchase an item that costs 2,000 Ghana cedis, and then the supplier decided that because I'm a regular customer, I should bring 19,000 Ghana cedis. Now the supplier has given me a reduction of 1,000 Ghana cedis. And that reduction becomes a revenue or more like a profit to me. Because if the discount was not there, that means I'm going to pay the full 20,000 Ghana cedis. So this time around, I'm receiving that extra 1,000 cedis. And it's becoming a revenue for me, or it's becoming a revenue to me in my books. So discount allowed is treated as an expense and discount received is treated as a revenue. And that is it, or that is all we have for today. And that is the end of today's lesson. Yes, the next video will tackle the types of journals in details. There's 7 types of journals. We'll be looking at the features and other aspects of it and how to record transactions in the journals. So don't miss that one. Yes, and once again, if you happen to like this video, kindly put a like button and then put all your questions in the comment section. And then also don't forget to share the link. It's very necessary. Help a friend, share the link. And then finally subscribe so that whenever we make an upload, you receive the notification. On this note, see you in the next video. Have a great day and stay blessed. Bye for now.